Yeah.
Awesome. What's up, everyone? Saturday Talks again. This time we have Chandrashekar on his part 2 of valuation of assets, and Siddesh afterwards on the sales process in the company. So, without further ado, Chandra.
It's natural.
So last week we have what I'm just giving an overview of what we talked about last week. So when we are trying to make an investment in assets, we try to figure out whether that investment is reasonable for us. We have to validate that asset. So I told you that if the fundamental value of the asset is the value you are paying for the asset, the amount you are paying for the asset is less than the fundamental value, then only it makes sense to purchase an asset. So this fundamental value is, we already talked that this fundamental value is nothing but the present discounted value of the future value it can generate. Like, if it can give me 100 rupees in the next year, the present value will be 100 by, the present value will be the value of 100 rupees right now. So if some asset gives me 100 rupees in next year, and I should first look at what is the present value of 100 rupees in this year. It won't be same because of the inflation and other stuff. Or if or the opportunity I am wasting without investing it somewhere. Suppose I have 90 rupees now. I invest in some FD and I make it 100 rupees next year. So 100 rupees next year is worth only 90 rupees now. It's not 100 rupees, 100 rupees. Both days. So we have talked about how an asset is valued. So I already told that the valuation makes very less sense in fixed assets like real estate or gold, etc. Now gold is to some extent, but real estate and all. Because the people buy a real estate to hold it for the like 5-6 years or even 30-40 years for a long period. So in that periods, valuing it doesn't have that much application. You may need to value it once a time. But it makes more sense in stocks because stocks are very liquid. Like you may need to buy an asset now and sell it next year itself. Buy a stock now, or even if you want, you can sell it in seconds. Buy it and sell it. So that's why fundamentals valuation of a company makes more sense in context of stocks, not in context of other assets. But still, the better strategy for you, even in any asset, is to buy below the fundamental value that it can provide. So first I'll put this aside, how to value a stock, but I'll talk about why invest in stocks, why it makes sense to invest in stocks. So if there is an economy, depending on the inflation rate, the federal governor or Reserve Bank governor decides the interest rates for the economy, lending rates. Depending on it will be slightly above the inflation, usually lending rates. Because inflation means the cost of any object is rising by that value. So if I don't make the interest rates above inflation, then the concept of lending itself doesn't make sense. Only if the lending rate is above inflation, it makes sense. Someone would try to put in bank only because of that. So usually Reserve Bank governor decides, if suppose inflation is around 6, he decides the rate at around 7.
What are the rates you mentioned? Lending rate, inflation, and?
One is repo rate. Repo rate is what the government lends to the banks.
Oh, I don't understand how that works. Can you just very briefly?
So
We started without anyone.
It's not recording the idea.
Yeah. If you people are late, we'll start.
Do you want, I was taking just to mention it and you want it on the camera? Done.
So by the way, that was Ankit who came extremely late.
Yeah, that was not mentioned till now. No, it's me. Yeah, okay, cool.
So if so how banks work on saying? Banks work on banks take loans from Reserve Bank, from the government basically.
Okay, but I was thinking, see, you put money in the bank as savings or whatever. People deposit money in the bank, so that is money that the bank already has. Out of that money, I assume the bank would loan out a certain
That
amount
is one of the factors.
and make profits off of that,
Yeah.
and use a part of those profits to give back to the depositors.
Yeah.
And whatever
That is also clear.
yeah, I thought that was the only way
Oh,
banks
no,
make
no,
money.
no.
I didn't know.
Now that is not the completely factor. Like bank has money through many sources. Okay, one source is what people deposit money in the bank.
Okay.
Another one is lending money from the RBI. Okay, another one is like getting from the government and other like investing other.
I didn't know about this.
Yeah, yeah.
So that works
they
for-
also take loans from RBI. So RBI decide fix it.
But
a rate,
RBI
what
gives
we
it
call
at a-
bank rate.
Repo rate something.
Bank rate we call it. Repo rate is the rate in which overnight we take a loan or something. Like
Repo rate is
Fine.
usually the
Yeah.
rate banks.
on which RBI gives the loan, but
Ah.
that is like some on like the overnight period is given. In that you have to take the loan. The right now the bank rate is like 7.5%. On that.
That is savings interest.
No, 7.5% is the rate on which RBI gives the loan to the bank.
Okay.
Now bank gives the loan to the people. That is like 7.5 is there more than that.
Like
That's
12 plus.
No.
No, different kinds of loan are
More than
different.
that, like
Depends on
yeah.
that, yeah.
Like FD, if you go for 8, the bank will give you 8%, 8.5%, like that.
Okay, the savings rate you're saying. Okay.
FD is we putting in money. No?
Yeah.
So
Bank
are you
lending is
confusing-
personal loan, car loans.
Okay.
Either 10 now 9%
Yeah,
is
that is 11%, 12%.
Education loan, housing loan.
education loan, housing loan. Mainly corporate loans where it lends to businessmen.
So can I ask a question?
Yeah.
Why can't a person yeah
Take it.
take a loan from
RBI.
RBI? That's probably a stupid question.
No, like
No.
basically the bank is as a service provider.
Okay.
For its service, because besides if they are giving you a loan, they have to do a calculation of how risky you are, how probable that you can return the loan. All this maintaining cannot be handled by the RBI itself, right? Bank.
Okay, so basically, okay, just finish.
Ideally, let us assume there is only one bank. So in that case, that is Reserve Bank. I can put my money in the Reserve Bank. So Reserve Bank can create false money. Like it need not be there. They can lend to people without in expectation that they will return in future. But you cannot always lend money like that because if that doesn't come in future, the economy is like wrecked because it spoils all the trade disbalance in the economy. They give money like this.
So,
Inflation will escalate because there is no value for money.
So basically, inflation rate should be less than the repo rate.
It's not a necessary condition. Usually they try to maintain that. Suddenly if the inflation spikes up, it's not that suddenly interest rate they don't spike. On a long term average they put it slightly up.
What is the inflation rate?
In India it's around 6%.
Right now, yeah.
But it has like 2-3 years ago it was 15%. It fluctuates. But right now they have set a target of 4 to 6%. So overall inflation, if suppose the average inflation is 6%, on FD you are getting basically 7%. Or sometimes inflation rises. So you don't get more than 1% or something above it. So if you stay for even for holding FD in 20 years, the real growth you are getting through fixed deposit is nothing. You are just having the same money with you.
You're just protecting yourself from inflation, basically.
Yeah, you're just protecting yourself. If you're holding cash, that's the worst thing always. Holding cash is like it always difficult. In a growing economy. If economy is falling, then always holding cash is the best option. Am I making sense? If economy is falling, that means on an average interest rates will be negative.
Oh, I don't understand that. Why is that?
I do.
Like
The interest rates will be less than the inflation.
no.
That's what
If
you are
economy is
saying.
falling, it falls. That means on an average, if someone is trying to do business,
Give me an is there such an economy which is falling?
yeah,
Give me an example.
like for a period of time it falls.
Oh,
right?
like that. Okay.
What do you mean by falling economy in terms of interest?
GDP.
In terms of interest rates, why is it? Why
No,
holding?
no, I am not saying.
So why holding cash is more advisable in a falling economy? Just explain it. Mathematically.
I am telling you. See, if I am lending some money,
Mhm.
it makes sense only if I get that money plus all the spending I am doing in return as a bank. If I am a bank, if I am lending some money to people, I am running the bank. So it only makes sense for me to run the bank that people can return the money plus all the management costs that I make. Then only it makes sense for me to maintain a bank. Right?
Yeah.
So, if suppose I am lending money, but on an average, the economy is not growing up. So on an average, that means if they are putting some investment, they are doing some business, and they are actually losing the value rather than creating value. If I try to set up a steel plant, I invested 100 crores, but I am making losses or the profits are not as much enough as to give me that 100 crores back in future. So that means that the value is depreciating continuously. So if I am lending some money and they can't return me back, so the point of lending itself is lost, right? So there is no. So I can only lend money if someone gives me money and takes less money in return. Then only. Suppose if I am lending 100 rupees, okay, and in the future the expected value I am getting is only 90 rupees. The expected I can withdraw from people. Suppose. Or assume 100 rupees itself. I am putting zero interest rates. So now I am doing business. I am taking deposits from people.
Okay.
So if I am taking deposits from people, then it makes sense for me only if 100 minus whatever cost I am bearing. Suppose for a year my maintenance cost is 2 rupees. Okay. So if the only way I can make my
Only if you get
run the
one
business is if someone gives me 100 rupees at this time and willing to accept like 97 rupees at that time. Okay, in future.
Okay.
On which one is my profit and two is the maintenance cost. In that case. So it's not viable unless people do this. People don't prefer doing this. So all the talks about this.
I don't get it. There is a scenario when there is negative inflation.
Yeah.
No, not negative inflation.
Negative growth.
90
Negative growth. The value can increase even if the inflation is negative. Inflation is value of price of one good only, right? Inflation determines price of one good. But value is price of all the goods produced. So now I am selling only 10 items at 1 rupee. 1 rupee profit. But in future I am selling for less profit, but I am selling 20 items. Still the 30 items. Still the growth can happen, right? Am I making sense? Inflation, growth can happen without inflation also, basically.
Basically, we are considering two countries, right? One is interest rate and one is inflation. Yeah, right.
Yeah.
So you are saying that if I deposit 100 rupees and after 1 year I get 100 rupees, back. That is the case when there is no inflation.
That is the case when there is
Zero interest rate.
when my expected returns are not there. That means economy is not growing on an average.
Okay. But in that case also, if the inflation is negative, the strength of a person to buy something like 1 rupee, value of 1 rupee will be more, right, and the inflation is negative.
Yeah.
Instead of 100 if I'm getting 97, then also it could be possibly, that the
Yeah, then it would be worth. But only if the value that I get is
like that is like some number which we have to come up.
yeah.
Chemistry team, are they occupied? The content chemistry.
Chemistry team. I think they're storyboarding.
Okay, so that's what I think. So on an average, the returns on FDs will be slightly close to inflation. So in real, even if you are holding FD for a longer periods of time, it doesn't create any value addition for me. It basically protects you from inflation, but whoever are doing business, these people take the loans that we are giving as FD. So after they take loans, since this whole thing is working out, that means they are taking loans and creating more value with that money. They are doing business and creating more money. So rather than putting in a FD, it makes sense for me to take that money, put that money and do some business. But since everyone cannot do a business, the better option is to invest in other business. So that you can see in the returns on average FD, gold, or any other asset. Usually equities are the best performers in general. So it completely makes sense for me to prefer equities over FD on an average. On an average, if I distribute in the entire all the companies, then it makes sense on an average. Not if I invest directly in some company which is going to burst or something. So another, this is the first point I am making, why we should invest in stock market. The second point is, and there is something called compounding. Compounding is basically compound interest rate. So if I am having a 7% interest rate, should I get some? So if you are having a 7% interest rate, so the returns, the number of times that money will become in 10 years span is 1.07 whole power 10, using the compound interest form. So if somehow I am making some 15% returns, so although the difference seems small for 1 year, 15% and 17%, this 1.15 whole power 10 if I do, it will be close to like 4 or 5 times of what the entire return I make in a year on 7%. Okay, if the interest rate returns are 7% and returns are 15%, although on the first year it seems that you are making 7,000 and 15,000 on 1 lakh. On a period of 10 years, if you see, because of this compounding, whereas FD may double your money, this gives like 4 or 5 times. So there's a huge gap basically, I'm saying, in comparison with FD. So this is the other argument why it makes sense to prefer, why it makes a lot of sense to prefer higher returns. Now I told you about this equities.
Okay, I have to go to second floor.
It's okay. So equities or shares, like Now, what are equities or shares or stocks? If suppose I'm running a company, I value that company at 100 crores. I want more money to be pumped in. Like right now, I have some cash issues or something. I want more money. So what I do is, I make this 100 crores worth of my company in 100 equal shares, for example. So since I need 50 crores worth of money, I'll issue 50 more shares to someone who is willing to invest in my company. So the total number of shares will become 150 crores. Sorry, 150. And the total value of the company will become 150 crores. Because 50 crores is pumped in. Earlier it was 100 crores. Since 50 crores is pumped in, 150 crores. This is how you usually start a valuation and all that. You define a valuation for your company. Then you propose this valuation to someone who is willing to invest. If he accepts, on that valuation, he agrees to pump the money, and the number of shares will obviously increase. So a share is nothing but a part ownership in a company.
No, I don't agree with this. Then technically I will just keep increasing the number of shares, and theoretically my valuation will go infinity. How can valuation just go from 100 to 150?
No, if people are
he has pumped in money, then I agree.
Yeah.
But the valuation, the post money valuation becomes 150 crore with 150 shares as well.
Yeah.
So I don't agree with the post money pumped in valuation because then theoretically you can just keep increasing valuation.
If someone is theoretically putting money directly into my company,
So that does
can go
increase the
to
value of the company as a whole. But then theoretically you can just, what stops people from increasing valuation?
The value that each person is getting is not changing. Right? If I'm buying one share, it's still 1 crore only for me. So if 100 people give you 100 crores to me, at that point it still remains as 100 crores. So
I don't get it.
if suppose my current valuation is 100 crores, and if some new person is coming and putting in the 50 crores into my company, so the total valuation is 150
My
crores.
question is like, let's say two of us have a startup, and we have 50% shares of it, and the valuation of the company is, let's say, 100 crore. And now someone comes in, puts in 50 crores.
Yeah.
So the shares now are like 150.
Yeah.
And so what will be? You'll be 50. So you have 50, 50, and 50 for that person.
Yeah.
No, percentage will be.
So in terms of percentage
will
will
be
be
different.
In terms of percentage will be
different.
But because that 50 crore is considered to be liquid cash, you are saying that valuation increases.
Yeah.
But then what in case of say a shareholder who pumps in money and sometimes valuation increases by more than the value is pumped. There are also a lot of cases, right? So there are Uber.
Yeah.
Uber kept on raising money. So whenever Uber raised money at say a 25 billion valuation and raised 1 billion.
That's because of the value they are creating parallelly. So when
So
they're
how do
doing
you explain that?
No, this is if money at any time the value of 100 rupees is of any asset is always 100 rupees.
Okay.
So if I take a company, I add 100 rupees more to it, the valuation directly increases by 100 rupees. But using that 100 rupees, the company is also creating value. So the value of it is increasing. So shareholder wealth is also increasing value. So what the equity is basically part ownership of a company. So if I value a company at like 1,000 crores, this valuation is called the value of the company. I personally do some valuation, and I think the company is worth 1,000 crores, and if and it has 1,000 shares overall. Okay, overall the number of shares is 1,000. So that means the value of each share for me is 1 crore. Makes sense. If I want to buy, obviously I cannot buy 1,000 crores at once, but someone is selling one share for me in some stock exchange. Stock exchange is where the stocks trade usually. It's like some mandi, like some market. So the if I feel that it's worth 1,000 crores, so one share will be worth 1 crore for me. So usually you will see like TCS is trading at 5 lakh crore market cap, but one share of TCS is worth 2,000 crores. So if the company is growing at 10%, even if suppose the valuation of the company will grow at 10%, even my share will grow at 10%. So all this I am talking about the fundamental value of the company. But the point, most important point is, companies don't trade at their fundamental value. Companies can literally trade at any price. It is if someone is willing to pay 1 lakh crore for a 1,000 crore company, so the company starts trading at that price. So basically, what in the stock market and all, what price you see is the last traded price. So if price is 100 today, some people soon start trading the stock at 1,000 rupees tomorrow. So the stock price is 1,000. Okay, but the fundamental value is still there. The fundamental value of the company doesn't change in one day as such. So the basic thing the people do while investing in stocks is they try to value a company when investing in a stock. So when they find that each share value is trading at below the fundamental price, they try to invest. So the thing comes up, how do we value?
So like if we have a share of 100 rupees, I have to buy it. Let's say a share of TCS is like 100 rupees, I have to buy it. So if I buy it, let's say 5 shares, I'll have to pay 500, right?
Yeah.
For 5 shares. But you're saying that last traded price. Why will someone pay more than the price which is shown? Like how will it increase? Like from 100 to
No, there is bidding and it's like auction only. Someone will bid and someone will ask. So someone will say that it's continuous bidding will be there. So when the bid and ask price matches, trade will happen. I will put a bid. Basically, if I won't buy the stock, I will put a bid on the stock. I will say I am willing to pay 99 rupees for this stock. Someone again comes up suddenly, okay, I am willing to sell it for 99. Then the trade happens. That is marked as the price of the stock, 99.
So I think I answer. So see, any share has something called as a face value.
Yeah.
Okay, say 5 rupees. Okay, so for example, a share of Infosys has a face value of I think 1 rupee, right? Infosys share face value is 1 rupee, but it is currently trading in the market at 2,000 rupees. Okay, so it implies that 1 rupee face value was when the company was ready to sell that particular share. Okay, that is the face value of the share. But today, the fact that it is trading at 2,000 rupees is exactly what he is saying. The market perception is that this company is valuable. That's why they expect the share value to grow even further. And there is some person in the demand. There is demand in the market for that share at 2,000 rupees. So that's why that value is 2,000. That is how it is.
So sometimes, like gold jewelry, if you take gold jewelry, gold, the economic value you can create using gold might be very less. In you putting in some, usually gold is used in various maybe science related things, nanotechnology and all. So the economic value you can create by selling that amount of gold could be very less. But there is a fancy because gold is limited. So people always, since there is a fancy, they always trade at that value wherever they want.
So that is what, just like stock prices, you have a gold price.
Same, not the gold, everything. Commodities, metals, everything has a price. Even futures. So for example, futures, derivatives. So how much will this stock be on 30th October? That also is stated. So all these OFD, options, futures, derivatives is about that.
Focus and research and all of them.
Okay.
So I forgot one point actually. So I told you why it makes sense to invest in shares. That I missed out on one there. So, but again, if we take me as an individual investor or you as an individual investor, there are people out there who are like professionals who are like totally experienced. Those people easily make more money than you. Like, why is it? Because suppose there is a very experienced fund manager who actually takes in money and manages the money. So he's supposed managing an assets of worth like 20,000 crore. And there are a number of stocks in the market trading at like 1,000 crore overall valuation, not per share. Overall valuation they are trading at 1,000 crore. So this guy has 10,000 crore, and if he tries to buy like some 100 crore worth of the stock over a period of some 1 month, so because of his buying, so much demand is created. So he cannot keep on buying at that price. The price will escalate like anything if he's trying to put 100%. So you as an individual investor, even if I put all my worth in buying that price won't increase. The price will be short. So whoever the big people, it's not easy for them to invest in normal companies. So as an individual investor with less value, with less worth, it's always easier to make more money on an average than the other professionals who with a lot of money, if you are informed, only if you are informed. So this makes sense as an individual person to. We now we have seen the question comes up finally. How do I value the company? So for the purpose of valuation of a company, or to understand how much the future value, how much the company can grow, what are the growth opportunities of company. Companies share to public, whichever companies are listed, they share to public some statements of their financial statements of what they are doing in the business, like how much cash they are generating, how much profits they are making. So there are 4 types of statements like that. One is the most common one is the profit and loss statement, profit and loss. The other one is balance sheet. There is one more thing called cash flow statement, and there is one more thing called equity statement. So the profit, if we look at a profit and loss statement which the company shares with you, so the company tells you like how much products they have sold, how much this thing they have, how much revenue they have generated, how much expenditure they have incurred, all that, and how much profit they have made. That is understood in a profit and loss. It's a basic accounting thing, and it's simple arithmetic. To understanding it's not at all difficult. Simple profit and loss, it will be how much is the expenditure, how much is the inventory cost of the materials. It's simple statement. There is one more statement called balance sheet. Balance sheet tells you, as the company is making profits, the whatever worth of the company keeps on increasing. So if the company today makes 100 crore profit, according to the company, the book value of the company increases by 100 in books, not in value terms. If they made a profit of 100 crore this month compared to the previous year, so in books the value of the company is increased by 100 crores. Okay. Is it
The fundamental value.
This is the increase in the profit. So
if suppose there is some, say there is an accountant in the company. He maintains all the books, all the finances of the company. So if suddenly but they cannot say you that this is the value of the company just like that, using some valuation technique. They have to show you that this is the profit it has made. So if so the book value addition will be 100 crore if it makes a 100 crore profit.
That is an increase in fundamental value of the company.
It ideally should be the increase in fundamental value of the company, in one sense, current worth. But if suppose I have made a profit not in terms of cash, but I have made a profit in terms of I have invested that profit in some land, suppose, or in some other thing. The book value doesn't grow with in future. The that is always marked at that value.
Yeah.
So book value doesn't represent the fundamental value of the company. Did I make sense? Should I tell one thing? So
Since I have 1,000 crore company, I made 100 crore profit.
yeah.
So you're saying in the balance sheet, they will add 100 more crores to the fundamental value, to the
Book
book
value.
value of the company. But that wouldn't be the fundamental value.
Yeah.
Because I might have invested that money somewhere elsewhere.
I would have invested that money maybe in some equipment.
Okay.
Okay. So the equipment, even I budgeted at 100 crores, it doesn't mean that it's always remains at 100 crores. Right?
Okay, but the book value would remain constant, would
Book value
increase
is
from there.
Yeah.
Oh, okay.
So in profit and loss statement, depreciation is also calculated. Depreciation of the assets.
That is, depreciation of assets will not come in the book value, right?
It will come because in profit and loss it is included.
Okay.
While calculating profit and loss, I also calculate the depreciation.
But then if you purchase some equipment and then over time the value of the equipment or the money which you had invested is going down.
Yeah.
So wouldn't
Suppose
that
if your
get
inventory is
balanced?
gold, suppose. If suppose gold, when I bought, the gold was some 100. Okay? There is no depreciation for gold or very less depreciation. But the value of gold now is maybe 1,000. But still on the books it is only 100.
Oh, okay. If there is an
Because if it is gold, but if it is something else like land, you cannot know what is the value. So companies don't mention the present value of it. They only tell the book value. So book value gives a faint idea of how much valuable the company is. Okay. So the balance sheet is also a financial statement. If you look at the balance sheet, you will get up to how much valuation is happening all the years. There is one more thing called cash flow statement. Cash flow statement shows you how much cash is. Suppose if I have a company and I got 100 rupees cash profit this month, and all the 100 rupees I used to buy some land. So suddenly it happened that I am illiquid now. I don't have any cash to spend. Although I created profit that year, which I invested in that land, but I don't have any money, so I cannot run the business. So there is a necessity of cash flow statement, which shows how much cash we have now, how much cash the company is generating through its function, and how much cash it is investing. There is one more cash flow statement. There is one more equity statement which gives the how much shareholders are putting in money. Okay. So using this, if you look at a general stock, I told you people usually have some valuation techniques to value the company using all the matter content available in the financial statements. So I already told you, if a golden goose gives me 100 rupees every year, so the value, I already told you how much I can pay for that goose this year. Right? It's the present value of all the money that it can generate in the future. That's the value of that goose. So basically, if the company is showing you 100 crores profit every year, okay, suppose. So what is the value of the company? What is the value of the company? Using the same, you can arrive at some valuation. Okay. So there are various techniques for this valuation of the company. So the first thing is based on the earnings, how much earnings it's making. Okay. So the same way how the golden goose is like making the earnings for you, this company is same way making the earnings. I can value the company. The other thing is sum of the parts. There is something called sum of the parts. If suppose the company has 1,000 crore worth of land, but every year its earnings are like hardly 1-2 crores. Okay, so then if I do the valuation using earnings, the real worth of company is not more, but still it has 1,000 crore worth of land. So the other valuation technique is sum of the parts. If I have like so many sections in the company, I will calculate all the worth of individual parts and then I will value. By the way, all these details will be shared in the financial statements which the companies release every 3 months. Okay. So either I can using the earnings I can value the company, or using the inherent value that I can value the company. So if you open a typical page, like if I want to buy TCS, okay. So if I open if I search for TCS and check out the stock prices, you will be given some to identify whether the company is trading at extraordinary prices or extraordinary low prices. What I can do is, there is something called price by earnings ratio that I will find. Price by earnings is the value of the company, the price the company is trading at right now, divided by earnings it is making every year. Okay? Got it? The value at which the price at which the company is trading right now, divided by the earnings it is making every year.
Price of one share.
Price of one share by earnings of one share. Earnings per one share, or price of the whole company by earnings of the whole company. Both will give the same. Okay?
So, what does this value indicate? So high value means we should invest, or low value means we should invest?
High value would mean that a company is promising. At least
No, yeah. This is the price per earning method. So, in the case of that golden goose, the earnings are 100 rupees. So, on a rough calculation, I value it 1000 rupees and I am buying it at 1000 rupees. So, my price by earnings is 1000 by 100 is 10. Okay?
Earnings per share is like the profit you are getting per share, like it's like a debenture or something.
No, not dividend.
What is it?
The company is making per share. Profit the company is making per share.
Per share. Okay, the total profit divided by the total number of shares.
Yeah.
So, but why did you do 1000 divided by 100? Like 1000 is the total price. Is the total price of the company?
Yeah.
I'm not a little confused. What do you mean by price?
Price by earnings ratio which I am talking about is the total profit that company is making. Sorry, total value at the company which is trading at. If one share is trading at 100 rupees, that means 1000 shares are the value of the company is trading at is 1 lakh. It's called market cap actually, market capitalization. So that 1 lakh divided by the total profit the company is making, or value at which each share is trading, divided by earnings per share. If I take, both should give the same number. Right?
Yeah. So what does this value indicate and why?
Yeah. So in that goose I have got a rough price by earnings of 10. 1000, if I am paying 1000 rupees, the price is 1000 rupees, the earnings it's making is 100 rupees.
Yeah.
The
So
price-
logically, I'll tell you. Logically, price by earning of a matured industry. So for example, price by earning ratio of a matured industry like cement,
Yeah.
where there are a lot of companies and there is a lot of competition and stuff like that.
Yeah.
That would be low, because the future growth potentials of cement may be at a certain rate only.
Okay.
They cannot multiply or treble its value within a year.
Yeah.
So for these kind of companies, price by earning ratio would be stable. So as he said, anywhere between 3 to 10 could be a range for stable industries. So for a telecom, for example, telecom is currently trading at a price by earning ratio of around 30.
30.
Why 30? Because telecom still has potential to grow.
Yeah.
4G, this, that. For something like a social network, Facebook, for example, Facebook is currently trading at a higher price by earning ratio of like 18 now, because the market perception is that this company can grow further. So in that case, the share might be trading at a higher value as compared to its earnings. That's the implication of the price by earning ratio. So if for a particular sector, say for example in a telecom sector there are 3-4 players: Vodafone, Idea, Reliance, Airtel. If say a Reliance is trading at a very high, very different price by earning ratio as compared to the incumbents, that implies that either the company is doing something different, or that implies that the company has a scope for higher growth. Either that, or that the growth is unsustainable. Because logically, all companies should be running at a price by earning ratio in the same band.
Yeah.
So, to put it in technical terms, what Siddesh is saying, if suppose 100 rupees is what I'm making through those, so I value at 1000. But if the 100 rupees is may not be constant, right? In future it can increase. So in future the company